This is Mr. Palassa. I just wanted to give a little presentation on the income statement, the statement of owner's equity, or also called the statement of shareholder equity. Depends who the owners are, and the statement of cash flows and the balance sheet. All right, so I don't want to I don't want to make the video too long, but I just kind of want to give you a little start on the anatomy of these statements as presented in Chapter 1 in the Ainsworth text. I think it's a good thing that the accounting book throws these statements at you right away, because typically an accounting textbook will wait till the whole process is done and then show you the financial statements. And I think sometimes seeing these statements up front right away is going to give you a better idea of what the big picture is, what the end goal is of the accounting process. So let's get started. Let's start with the good old income statement. And this is also sometimes referred to as the profit loss statement. And what this is it's a period statement, meaning that this is done for a specific period of time. It could be a month, it could be a quarter, it could be a year, but the income statement is going to show financial results for a specific period. So again, kind of going back to the analogy, if you took the Cubs or the Sox season from last year, really doesn't have anything to do with the season that's happening this year, but the cumulative effect of all of the wins and losses. You would say the Cubs had a good decade, the Cubs had a good century, the White Sox had a good decade or a good century, and but each individual season is measured on its own period. Okay, so the income statement is the same way. So here's how every income statement starts, regardless of what type of business you have. It's always going to start with the revenue. And if you're a service industry, like a lawyer or a painter, it's always going to start with some kind of fee that you're not necessarily selling or manufacturing or producing a product. You are providing a service to somebody. So revenue in a service industry is always a fee. If you are a merchandiser, then the revenue is going to come from the sale of a product. And in same thing with manufacturing. If you're a manufacturing organization, you will sell a final product that you created, that you manufactured, that you put together. All right, so everybody starts off with revenue. The next part of this is going to be less cost of, and we'll just say sales right now. Again, if you are a service industry, this part really doesn't mean anything. It's only if you are a manufacturer or merchandiser. And a merchandiser has to acquire a product from somewhere in order to sell it, and a manufacturer has to produce a product and put it together before they sell it. So this part here is going to be subtracted from the revenue to find out what we call gross margin. All right, and gross margin refers to how much money did we make doing what we do. If we produced a product or manufactured a product, how much money did we make after the expenses that were associated with manufacturing it? And if we were a merchandiser, what were the costs associated with acquiring that product and selling it? And when we say acquiring that product, is from a supplier. All right, so whether it's cost of sales or cost of goods, sometimes it's called cost of goods sold, sometimes it's called cost of goods manufactured, as we'll see later. That part of it is going to get us to a number that says after we spent the money to get the product or manufacture the product, what do we have left over? All right, so the next part is going to lead us to something called selling and administrative expenses. Okay, and selling and administrative expenses are all the other expenses that come along with the business, like marketing expenses, expenses for the people that work in the office. And this is again going to be a less selling administrative expenses. All the things that come along with the other things besides what actually goes into acquiring the product or manufacturing the product. So electricity, utilities, um, advertising, marketing, salary expense. If you're manufacturing this, the salary expense of the manufacturers themselves would go into here, but the salaries of everybody else would go down here. So it's basically all the other expenses that come along with that are associated with the business, but not necessarily associated with the manufacturing or the acquisition of the products that you're selling. Okay, but nonetheless, it is a big part of figuring out net income, which we want to finally get to. All right. So after we get to that part, we get those are all of our operating expenses. We would get to what we call operating income. Okay, and then a business always has some other things that they make money from. For example, maybe Apple is going to make some money from investing. They're going to take their money and they're going to make some investments and they're going to get some interest income from giving loans. Maybe they're giving loans to somebody because they have so much money. But they're not in a business of giving loans. It's just something that they're making money on, that they're kind of doing on the side. Maybe they sold some things and they traded some things, or they disposed of some, or not disposed of some things, but they traded some things that they made some money on. Again, they're not in the business of selling old equipment off, but maybe they did make some money from it. All right, so that those are what we call non-operating items. So I'm going to put plus or minus non-operating items. Okay, and then we would get to income before taxes. Okay, not necessarily net income yet, because we have to figure in, even though our net income is taxed, and then that becomes a tax expense, we need to factor that in because it's really not what we're making. All right, so we have income before taxes, then we have the tax, then we'll have a tax expense here. Oops. And then that'll finally get us to finally net income. Okay, so this is a pretty detailed anatomy. All the parts are there from an income statement. You have how much money you made, how much money it costs you to do what you do, and then all the other expenses that come along with it are subtracted, and they finally come up to something called operating income. And then some of the things that you make money on or lose money on that aren't associated with your business and what you do, it's going to be a net here. Okay, so a net of non-operating items, it's going to either be a plus or a minus depending on whether the expenses are greater or the revenue is greater. Okay, and that becomes what we call income before taxes. Then we figure out the taxes, we subtract the taxes, and then that gives us our net income after taxes, otherwise known as final net income. That's how much money we are going to bring in a period after we pay for interest, after we pay for taxes. What do we have left over? It's the same way when you go to work and you earn wages, a gross part of your wages, and then when they take the taxes away, what do you have left over to use? That's our net income, and that's what the net income of a business is. It's everything they've made minus everything they've spent, subtract the taxes from it, and that's what they get left over. That's what they get to put into their savings account when it's all over with. Okay, so there are the parts of the income statement. That's usually the first step in the process of the financial statements, is creating an income statement before you move on. So that's there for your reference. Hope you enjoy it.